Hello, everybody. How's everybody doing? Happy Tuesday.
Happy Tuesday.
Can you hear me, Jay?
I can hear you. Happy Tuesday.
Oh, good. Hey, welcome to the live stream, everybody. If there's nobody here, that's fine. If you can if you're watching this as a replay, there'll be a lot of good information on there. If you have questions after the fact, just put them in the chat and we'll answer them. That's what this is all about, so that once we get done live streaming, it turns into a video and it'll last forever. So if you have questions and you're watching the replay, just put them in there and we'll handle it for you. So I want to introduce everybody. Of course, in the middle there is Rodney Wilds, the VP of F&M Mortgage. Worked with him for a long time. Hi, Rodney.
How are you?
What's new? What's new this week? Anything?
Not much anything. It's a pretty quiet week coming back after the 4th of July. Things, everybody's on vacation. It's looking at a little inventory, though. Inventory seems to be picking up, so it's pretty good.
And still people writing contracts, I'm going to guess?
Oh, 100%.
Oh, good.
Good. I still feel the first-time home buyer a little bit of a crunch. They're not getting their fair shake at the closing table, but I say that they're just not buying. The prices and the house prices kind of drove them out of the market a little bit. But other than that, it's okay.
Yeah, well, it all comes around. We made it through the crash. We'll make it through whatever this is too. Whatever it is. And the fellow on the right is Jay Alexander. He's a title attorney. I've been working with Jay for a long time. I trust him with the details and getting things done. Title companies are the ones that handle everything at the end, and I depend on him greatly. He's with a company called Chapman and Rosenthal here. We're all in Brentwood, Tennessee, Williamson County, so we're sort of unified in that. And Jay, you doing all right today, this week?
I'm doing all right. Kind of like Rodney, I feel like everybody's out of town on vacation right now, so it's been a little quiet the last couple of weeks, but yeah, everything's going well.
Quiet is good. Well, Rodney had a question or a thought last week when we were talking about topics, because we have to come up with topics every week to try to be helpful to people, because that's all this is trying to help somebody that's got questions. And we don't have a dog in this fight. If you live in Portland, Maine, or Portland, Oregon, or Tampa, Florida, or Austin, whatever, we want to help you. We're not trying to sell you anything. We're just trying to provide information to you. And we're trying to provide information that's global and broad in its topics, so it can help as many people as possible. So hopefully today's topic, the 1031 exchange, will be helpful for those investors out there, because I think it's limited to investors, probably, right? Full disclosure, in all the years I've been in real estate, 17 years, I've never had to deal with a 1031 exchange yet. And I've been able to facilitate those with other people, but that's not something I've done. And so Rodney and I have brought Jay Alexander on here because he's the 1031 guy. He's the guy, the 1031. So let me start it this way, and then just to kind of frame it and just jump in, either one of you, as always, where you need to shut me up. So what I've got is what today's video is about, live stream, is what's a 1031 exchange? What are they used for? How do you use them? And what's the smart way to approach this? I suspect that there's better times to use them than not, I guess, So what are your first thoughts on 1031s, Jay?
Well, the kind of the basic idea of a 1031 exchange is, or the most traditional we see, is you have an investment property, you're going to sell it, and then you want to buy another piece of investment property. The 1031 exchange allows you to defer the taxes on that property. So you sell the first piece of property, that money goes to a 1031 intermediary. You, as the seller, don't take possession of that funds. And then when you go buy the new property, that money gets transferred for that purchase. And so instead of having to pay taxes on the gain at the time you sold that property, it just rolls into the new property, and then you would eventually pay taxes down the road when you sell it or you potentially roll it. But it allows you to keep more of your money and use it towards a replacement property, as opposed to having to pay taxes and have less money available to buy a new property.
And you mentioned an intermediary.
Yes. So we, as the title company, our role is pretty similar to a normal transaction. So we're doing a title search. We're getting all the statements together. The intermediary is who holds the funds and does the 1031 paperwork. So there's several out there. They're all over. The big thing I will tell people is make sure you want to go with someone that's reputable and that's been around and has a lot of backing, because they are going to hold those funds during that 1031 exchange period, however long that's going to last. And so you want to make sure that they're going to be there and that, that money is going to be safe. So that you definitely want to go with someone that's been around.
And is that different than, and you might have answered this and I missed it, is that different than a bank? I mean, is an intermediary different?
Yes, an intermediary is they're specifically set up to hold those funds, and that's all they do is hold 1031 exchange funds.
Is that similar in scope? How brokers will hold have an escrow for trust money and stuff? Is it similar in scope to that?
It's similar. They're holding it in escrow on your behalf. The reason they have to do that is for a 1031 exchange. It's kind of a like kind exchange. It goes way back in the tax code. It was where you could kind of, in theory, you could swap houses with someone and kind of defer. But since that rarely ever is going to work out or happen, they've created this 1031 exchange piece where the money goes to an intermediary. So it gets held. So you, as the taxpayer, you never take possession of those funds. So when you sell the property, the funds can be held until the time when you purchase the property.
So literally, the intermediary, if I'm reading this correctly, all that's happening is the investment property owner never has the opportunity to have the cash in his hands.
Correct.
It's kept completely separate, and so that there's no funny business. Is that?
That's correct. Yeah.
Is that why?
If the taxpayer takes control of the funds, then you could ruin the 1031 exchange and then wind up having to pay taxes on that.
Okay. Now then you say that it's deferred. All right. So if there's a benefit, so see if I've got this right. So you get to defer the tax so you can use all of your funds to buy the next property. We'll go into that in a minute. But if it's deferred, at what point do you have to surrender it? Then when you sell that particular property, or?
So if you sell the new replacement property, if you sell it and do not do another 1031 exchange at that time, then you would owe tax on the gain. And what happens is whatever your basis was on the original property. So let's say you bought the original property for $300,000. You've rented it, you take depreciation. So now you've got $200,000 basis. You go and buy a $400,000 property. That $200,000 basis moves over to that property. So you didn't pay $400,000 for the new property. It's that $200,000. So then if you sell it for $500,000, you would pay tax on $300,000 at that time if you didn't roll it over. So.
Okay. And all right. Okay. I thought that was.
Can I jump in here, Andy?
Yeah, absolutely.
So if I utilize a 1031 tax exchange and I sell my house for $500, and I bought that house for $250 previously, and I go out and buy, let's say I go out and buy a $750 house. So my baseline on that $750 house starts at $250.
Well, $250, then then plus the 250 you put into it. So yeah, so 500. So your basis then would be.
So they're going to hit. So they're going to get their equity. They're going to get their equity. You're setting your baseline with with the kind of the tax penalty or tax bill coming up already in there in that new price.
So that's why they call it a deferred exchange. So you're deferring the
Yeah.
tax. You're not eliminating it. You're deferring it. And there
Yeah,
are
I
ways.
didn't know that. Yeah.
Yes. So it gets deferred. And then there are situations. So if you keep deferring, and then you own that property when you pass away, then your heirs, as of now, would get a stepped up basis. So in that case, it would get wiped out. But the actual, you're just deferring the taxes. And so what it does is, in your case, so if you sold that property, instead of having to pay capital gains tax and having less money to use as a down payment on the new property, you get to roll all of the gain into the new property. So you can either buy more or borrow a little less, but you can get a bigger property and use all of that money towards that piece of property.
So the bottom line benefit is by being able to defer the taxes, you can use those funds.
Well, mine froze up. Are y'all froze?
No, we're good.
I'm good.
If it defers, then you can use that to profit more. Okay, correct. I get it. All right. So let's try something. Rodney, are you there? Did he freeze up? I wonder if you can see this. Sorry about hey, it's live. I'm going to type this in there. Well, here's what we're going to do in the meantime. I think Rodney's going to have to dial out. Can you hear me, Rodney? That's going to be a no. All right. So Jay, here's what I've got in here. So here we've got our timeline. There we go. Thank you. I'm in. You're in twice now.
Was it something I said?
Kinda. Okay. Are you there? Let's see. Okay. Everybody's good now?
Yes.
Okay. Rodney, can you hear me?
I can.
Okay, good. So here we have the exchange timeline. And I know that for me, whenever I thought about this, can you see this okay? Both of you? The
yes.
slide? Okay. So tell me about the timeline. Why do they even have that, Jay? Why?
It's so all of this 1031 is the section of the IRS code that allows this to happen. So the reason they have timelines is that is what the IRS has determined works for these 1031 exchanges, and basically what you have to follow, the steps you have to follow in order to qualify. So since, kind of like I said, that example where in theory what they're trying to do is create where you're transferring like kind exchange, but they realize that more often than not, you're not going to be able to do that simultaneously. They come up with these rules that you have to follow in order to qualify.
Okay. And Angie has jumped in here. She's been with us a couple of weeks. And she had a question. Jay, I'm going to throw this to you so you can.
Oh,
can you see that? Okay.
Yes. Yes. So, we've seen a lot of 1031 exchange activity over the last 3 years, probably more so than we've had prior to that time, because the gain in property value has been so much that there are substantial capital gains taxes that would be owed when these people are selling property. So when the market's doing well, you see big jumps in prices. That's when the 1031 is going to be most beneficial because you're saving the most in taxes. If your gain is not very much, it may make sense to go ahead and just pay the taxes now and then and then do a 1031 later at that time.
Oh, that makes sense to me, because if you have a piece of property that jumped from, I'm going to make up numbers, from 500,000 to $1 million, that's a tax benefit
Right.
that you're talking about.
Right. Yeah. So if you bought for 500,000 and now the property's worth $1 million and you're going to sell it, you've got capital gains on $500,000. Whereas if you do the 1031 exchange, you get to defer all of that. If it's 500,000 and it's gone up 25,000, then there's 25. So you're only saving tax on that $25,000 then.
And that's some serious leverage if you've gained that much in value.
Correct.
And that's some serious leverage. So the next question that I have, and I think I sent you this ahead of time, but this is way over my pay grade, probably not for Rodney, but for me it is. This depreciation recapture. What?
So I think the idea of that is, so over time, if whatever you would have had to pay in taxes, if you're not able to apply that to the replacement property, then you're buying less value. So the higher dollar price you can get to, and then over time, whatever percentage that increases over time, it's just going to be more and more and more through compounding interest, all that kind of stuff. So whatever extra you can save now and not have to pay now and invest it over 5, 10, 15, 25 years, that's just going to be more and more and more money that you're going to have, as opposed to having to pay taxes now, buying less, and it's not going to increase as much.
Okay. Go ahead.
Meaning, if I'm saving $100,000 on capital gains tax on a sale, and I'm able to put that towards my purchase,
correct,
with saving it in the interest rate and being able to buy like property, I assume that this is that's what you're referring to, is that I'm going to be better off down the road because I was able to use my 75 or 100,000
correct
of capital gain. Instead of paying it, I'm getting to use it to purchase and to drive down my mortgage cost as well, right?
Correct.
By
now with the
less of a loan amount,
with the 1031 exchange, the purchase price, the value of the property has to be the same or more than what you're replacing it with. So it's more money that you have available to apply. So you can either have a higher purchase price, so if properties are appreciating at, let's just say 5% a year, and you can only buy a $900,000 piece of property as opposed to $1 million piece of property, that extra 100,000 as it appreciates over the next 10 years is going to be significantly more money than if you'd had to pay taxes and you no longer had it. So
that makes sense.
I'm curious as what to Angie's questions there as well.
Yeah.
Which one?
Well, it's they're all kind of tying in, but about the property value, really, it doesn't matter if the market's high or not. But I'll let y'all explain that.
Right. It matters more
based on taxes.
Yes, so it matters more on what the piece of property that you're now trying to sell, how much gain do you have in that property? So if you have a significant gain in that property, then it makes sense to do a 1031 exchange, now, because otherwise you'd have to pay taxes, and then you'd have less to spend towards the new property. But kind of the only reason you would not want to is if you think the tax rate is going to be a whole lot higher or something in the future, and you think I'd want to pay on this tax rate now as opposed to down the road. But the money that you're saving and getting to apply it towards more property and just in getting that benefit of compounding is what the benefit of the 1031 exchange is.
And I don't even know what this means. What does that mean?
What's the average capital gain tax now? I think depending on your income tax bracket, and I'm not an accountant or CPA, but I believe it's in the 15 to 20% range. And then you can also, there's some investment taxes if the dollar amount's high enough. there's a 2 or 3 more percentage points I think that can get added on to that as well. So,
but capital gains can be pretty daggone. That's a serious chunk of change. That's why this is
right.
pretty important, right?
That's where I was saying, if you had a 250,000 in appreciation and you're paying 20% capital gains, that's
Yee.
$50,000 less that you'd have to apply to the new property.
50,000, and that's just for. I get that's okay. So then here's the next thing I've got here is these are some options on how you can use 1031s. And for anybody that knows me, I don't know anything about 1031s. I pulled these slides, and I'm hoping Jay can explain them. But here's
Andy,
this one.
Hey, I do want to warn you, Jay, that your mom's standing in my doorway listening, so you better have your throat together.
Hi.
So what this slide, I'll kind of give some of the
Yeah,
basics.
he knows his mom's the expert around here too. You know what
He's
I'm
red. Jay's turned to red, man.
So one of the things you showed earlier, the timeline. So when you sell a replacement property or sell the relinquished property, when you sell the property that you're starting with, you have 45 days to identify new properties. And so you can identify up to 3 properties, no matter what the value is. So in this one, you can identify 3 properties. You have 45 days to do that, and then 180 days to close. And that starts at the time you sell the first property. And what you can do is you could also, if you have, let's say, 300,000 in gain on the relinquished property, you could put $100,000 down on 1, 2, and 3. And so you can go 1 property to 3 properties, 1 property to 5. You can do a bunch of different things. You don't necessarily have to go from 1 to 1 when you're buying property with a 1031.
How was let's say in this situation I got 300,000 equity that I have to use, right? They're going by whatever I'm netting from the house, right? After I pay the whatever, how much let's say that number's 300,000 I'm taxable on. And so I could put 100 on each of those houses, but how does that baseline transfer over, I guess?
So what you would have to do, so let's say you had 300,000 in equity. So you purchased the property, for 300, you're selling it now for 600. So each one of these properties would have to be, 200,000 each, or total 200,000 each. And then kind of whatever the percentage of that 600,000 was is how you would apply it to the 3.
Okay. So it's just divided evenly. What if my money was, what if I went 50,000, 200,000 as a down payment? Is it still spread evenly, or does it matter where the money goes?
That is a good question. That one,
I've never seen anybody do that, by the way. But
yes. So that would be a good question. So at a certain point, that's where the 1031 intermediary can answer a lot of questions. So if you're getting in these more complicated situations than just a 1-to-1, they are a great resource to go over all the timelines with you, make sure, and that's part of what they're doing, is making sure everything's, all the boxes are checked and everything is going in the right way, so you do qualify for the 1031 exchange.
And as far as let's say I get a customer right now, and I think they've been either discussing a 1031 or I think a 1031 may be good with them. My policy here is that if we do a 1031, we refer it to you guys. That's my thing. I was like, I'm not an expert at 1031, but I know somebody who can find it. Mm-hmm. Like, I can't find an intermediary, and since I'd have better luck. I don't, most people don't even know what an intermediary is. So how can a customer or an agent be able to find that, or they,
Hmm.
for me, it's easy for me because I'm going to say, hey, go see Jay. He's going to take care of it. But I do, and the other part of this question is, I know there's some stuff about the contract that needs to be done up front. Um, so I guess I got a two-part question is, for me, I'm going to try to direct that to somebody who's I know is going to take care of them with a good intermediary like you. Uh, but you said they need to kind of look for a good intermediary company. But how is that? Like for me, I don't even know what that is. I'd be searching for a needle in a haystack.
So what you could do generically is just, Google 1031 intermediaries, and kind of, go to sites you trust, see reviews on what people suggest. The other
Yeah.
the other option is like, go to your trusted mortgage advisor, realtor, ask
Yeah.
them, title agent, and they'll probably direct them to whoever they close with. Um,
Okay.
and so I'll give a plug. We recommend IPX 1031 Exchange. They're part of the Fidelity brand. So they have a lot of backing, a lot of funds. They've been around for a long time. So your money is going to be safe with them. Because like I said, you have 180 days from the time you sell the property to the time that you have to purchase. So that's a long time for someone to be holding on to your money. So you just want to make sure that money is safe during that time
Right.
period.
And there are stories out there where intermediaries went out of business holding funds. Isn't that true?
Yes, unfortunately that is true. Yes, there's been some where mismanagement, they weren't doing what they were supposed to, and basically lost the funds, embezzled them, that sort of thing. So
Oh,
that's why you want to go with one of these large, big companies.
yeah.
And
Yeah.
is that IPX company? Because like uh, like Angie's out of California. Is IPX a national company?
Yes, they're all over they're national, so they're all over the
Perfect.
country, and that's the thing with 1031. We've done a lot of 1031s lately, where people have sold property out west, and now they're buying investment property here. So you can do all over the country. So you can sell a property in one state, buy a property in another state. You can sell a property in one state and buy a property here, buy a property in Florida. So you can definitely spread it out all over.
And Angie, just a quick note, Jay's email is in the description. So you can send him an email and ask for phone numbers and stuff for that company if you want. Is that okay? Here I am handing
Yes,
out your email.
that
Sorry.
no, that's fine.
Oops. Anyway, you can send Jay an email. You can send all of us an email. That's good. We've got to answer this question.
So, yes. So, like the IPX company that I talked about, one of the things they advertise is they have $100 million in Fidelity bond coverage, 50 million in written performance guarantees, and 30 million in professional liability insurance. Um, so that's the kind of things you want to look for, is
Hmm.
what type of insurance and bonds and stuff do they have, because um, it's not like it's being held in a bank that's got FDIC insurance and that sort of thing. So it's a separate entity.
I understand, and that really, I mean, the importance of doing your research on a good company is,
Correct.
I can't even express that. So that's a real good question. We got more
Yeah,
questions for you.
yeah. That was to me, as many as I've done a few of these, and I never that point you brought up, Jay, about finding a reputable one, because I had no clue about, I didn't think about they're holding my money, and they're not FDIC. Like FDIC only insures what, 250 anyways,
Right.
250,000. So if you got a bunch of money with them, it's like, that's a really good point.
So what's the 95% rule? And I'm throwing this stuff out at you because I have no clue, Jay. Bird?
So when we were talking about, when you go to sell your property and you have that 45-day window to identify
Yes.
property, you can do like I said, you can do 3 pieces of property. It doesn't matter what their value is. It can be unlimited. This one, you can do as many. You're not limited to the 3 number. So you can identify, I think, 8, 9, 10 in this picture, as long as you follow through and purchase 95% of the value of the properties you identified. So that's what the 95% rule is.
So if one of those deals falls apart, that puts you at risk?
Right. Yes.
No
Well,
kidding.
Well, somebody would do this because somebody's going to do this knowing that some of those deals will probably fall through, but they're still going to buy, say, $1 million worth of properties or whatever, right?
Right. And there's another rule. This one, I can't say that I've seen this one come into play a lot. I think your next slide is
the 200% rule.
Yes. So usually we either see the 3, so where you're going to sell something, and then you've identified 3 pieces of property that you're going to replace it with. So usually that's in a 1-to-1. You're going to sell something and buy 1 property. So you've identified 3 different properties that you're going to pick from. In this case, this is where you may be selling 1 property and you're going to split it into 3 or 4 properties. You can do as many as you want in that, as long as the total value is not 200% more than what you sold.
More.
So
Okay.
So if you sold a property for $500,000, you can put 10 different properties down that total $1 million, and you'll wind up probably buying 5 or 6 of those 10.
Man, there's a lot of rules.
There are.
This. I mean, what's up with that?
You know, anything the IRS is involved
I'm
with.
not a good rule follower. I would.
Yeah, most of these, honestly, most of these are you don't see this. Like I've done a bunch of 1031s and seen the office do a bunch of them, and the most complicated one we've ever seen is where they sold 1 and bought 2 or 3 or 4, right? That's the most complicated. But if we're just dumbing it down, basically somebody needs to start out with going to their lender, realtor, or title company and saying, hey, I'm thinking about doing this. Let's run some numbers on a tax exchange. And that's what I did. I had one I was looking at sale because property's value is just going crazy. And I just went to my financial guy and said, like, how much capital gains would I be paying? And he told me, and I was like, okay, well, I'm going to keep it. So, so that's basically, this person needs to start out, no matter what part of the country they're in, they need to start out with like one of our professions and get hooked up with a good 1031 guy, and then double check their intermediary, make sure they're good.
Correct.
Yeah.
And that's, as Angie's question, sounds like it's just used by big time investors. That's where, so we've covered a lot of different elements of the 1031 exchange, but most of what we see is where
that very
somebody
first one
had a rental property, and for whatever reason they're ready to unload that one. They want to either buy something a little bit bigger. So most of the time it's from 1 piece of property to 1 piece of property. So pretty simple transaction. And we see those. That's probably 90-95% of the 1031 exchange we do. It's 1-to-1, where they're wanting a different part of town or a different state, and doing that.
So we're covering territory that's a lot more complicated than the normal person is doing this.
Yes, and that's the thing with 1031s. There's a lot of different options. So most people, when they hear about it, they know you can do the 1-to-1. But it's nice to know if you do have a property that you've got a lot of gain in, you could roll it in, and you may not want to purchase another property of that size. You can buy 2 or 3 smaller rental properties with that 1031 exchange. So it has a lot of different options to it, but It's not necessarily just for big time investors. I mean, we see, people would have one investment property and they do a 1031 exchange just because they want to roll that into the next one. So
Yeah.
So this brings me to one last, well, not my final question, but Jay, I can't thank you enough for what you've taught us so far today. But this brings me back to this one because I'm in the business, pardon me, of finding properties. And as you know, let's say in the last year and a half, if somebody was thinking about doing a 1031 for whatever reason, we've discussed it, take advantage of that tax defer. What if you start the process and you run out of time? You just run out of time? I mean, is that the deal?
Yeah. That's the deal. The timelines are pretty hard, fast. There's not really any extensions. I do believe there is one. If you get declared in a disaster area, I believe a federal disaster, that can extend some of the timelines. But those deadlines are pretty hard and fast. And I ran into that a few where people were scrambling kind of last minute trying to get a property under contract because their timelines were running out, or needing to get a property closed by a certain date because their time was there, it was running out. So those timelines are pretty hard and fast.
And so that 130 days is the close. I mean, so if
yes, so
from if anything gets in your way, you're in trouble, or you could be.
Yes, could be, but yeah, you have 45 days to identify that replacement property.
Does identify mean put it under contract?
You'd probably you submit a list to the 1031 exchange. You don't have to. It doesn't necessarily have to be under contract, but in our market over the last few years, with as fast as kind of everything's been moving, you probably have it under contract and then send in the identification paperwork at that time, because you're not going to send a list. I may purchase these 3 properties, and by the time you send it, all 3 are already gone. So
exactly, and that's the reason I bring that up.
And you have to find one within 45 days, because closing within one and 180 is not a problem. It's correct. Finding it within that first 45. So you better be ready to go when you sell your other one.
Yes. Yeah. So so from the sale date is when so when you sell the property, you have 45 days from that date to identify, and you go back, you have 180 days from the date you sell to close.
Cool.
It just sounds to me like, when I was reading through this, there's a thing called a timeline of a reverse 1031 exchange too. What's a reverse?
Yeah. So a reverse, those are a little more complicated. I've had 2 that were attempted this year that fell apart for various reasons, not necessarily because they were 1031s, but it's where you try and purchase, you're purchasing the replacement property before you sell the relinquished property. And I'm not, I can get way in the weeds, but basically the 1031 company sets up this LLC that purchases the property on your behalf. And then when you sell the property, you acquire that. So it does allow for, in your situation, if you're worried about selling and then not being able to close on a property or identify and close, it allows you to go ahead and identify and close and then sell your old property.
Same timeline then?
Same timeline. I think yes. So you have,
you just use your own funds, like you just use your own cash, and then you pay yourself back.
Yes. That's why, and there's ways you can kind of structure some loans, but it's definitely it's more complicated. You're not going to be able to go in and just get a traditional mortgage and do this. So it's either one, you've got cash and you're just trying to move it around, so that you can do it that way, or you can get a loan. You just have to work probably with a bank that's going to keep it on their books, or do some kind of business line of credit, something like that.
Gotcha.
Like I said, I've had 2 attempted this year, and both of them fell apart. So I can't tell you exactly what it looks like once it's all completed.
It's just, in my profession, it seems like it's that time thing, and it seems like if you've got 180 days, let's say, and because I've heard other people, they were screaming, I got to do something with this property. I've heard that, I've been around it. That seems that would lead to bad decisions.
I mean, it could, if you have that 45-day window, and if you got to get it locked in, during that time, and it could cause you to just get something just so you don't lose that 1031 exchange.
I guess
sometimes what I'll see is you can simultaneously go under contract too. So you can go under contract to sell and go under contract to purchase and close on the same day and do a 1031 exchange that way. So you don't have to wait until you've sold to then identify and move on. So you can give yourself a little bit of a buffer by doing that. But then, you do run the risk of if something falls through, then you got to go find something replaced real quick. So.
Well, it's any way you slice it, 1031 is you're playing beat the clock. Just get over it.
And the thing to remember, this is a special carve out that the IRS is doing to offer, this tax deferral. So that's why there's rule. You have to follow these rules to qualify for this deferral. So
otherwise, you pay taxes and you don't get don't get the long-term benefit of your own money.
Right, and that's what happens. And if you do, and that's another option. So if you sell something and you can't find anything, and you just let the 1031 expire. And then it's just like you never did a 1031. It's just like you sold it and never did it. So you're no worse off than you would have been. You just don't get that benefit.
Huh. So I think the bottom line then, I can't thank you both. This has been really, really good, Jay. Thank you very much, Rodney. Thank you for the question and keeping us moving here. What you're saying, I think, is that in this particular market, you're seeing an uptick in 1031. So it's an important topic for people to be thinking about that has investment properties these days. Is that right?
Correct. Because more so than any, especially the last 3 years, because of the increase in property values, people are sitting on a lot of gain, which would result in a lot of capital gains tax if they did not defer. So
that's really good. Well, I've learned a lot. I think I'm gonna think about what we've talked about. I was going to say something smart, decided against it. Editor.
Hey.
Oh man, this is really good.
You're a trip, Andy.
Any final thoughts there, Rodney?
No, man. Yeah, Jay, I'm with Andy. Thank you for the clarification on this. This is good info. There's a lot of people that could use that information. I'm like Andy. When I get something out of my area, I'm like, go see Jay. So I appreciate the input on it, buddy.
Absolutely. Jay, any final thoughts?
No. If you said my emails in the comments or you can. If you're watching this and have questions, you can email me, and I'm happy to try and answer or point you in the direction you need to be in. So,
which is what it's all about, because all of our emails and contact information is in there, no matter where you're from. United States, I think, probably United States. But if you have questions, get a hold of us either directly or in the chat. So hey, listen, guys, thank you very much. Excuse me, I don't know what's going on. It's been a real good Tuesday in dollars and cents. Thank you guys very much. Thanks a lot.
Yeah. Thanks, Angie, for joining us again.
Angie, thank you. See ya. It's different music on a go out. See ya. All right.
All right, boys.
Hey, that was good.
Yeah. Great job.
all right.
Hey,
Thanks,
y'all need me for anything else? I'm fixing to cut out of here and go watch my son play golf.
Okay, well, have fun with that. And Rodney, today's broadcast was really good, and I think I know what. I think I fixed the problem. So, anyway,
we don't have a problem. Hey, I'll give you a call. You want to call me sometime tomorrow? Let's kind of debrief today and see if there's anything we need to do different.
You bet. Sounds like I'm preparing for a beating.
You know, man? Oh no, I was talking about you for me.
No, that was great. Jay, thank you. That was great. I'd like to do this again, and I'd like to do this again with you, not on 1031s, but for
Sounds
title
good.
stuff if you're open to it.
Okay. Yeah, no, that sounds great.
Thanks, guys. See you.
All right,
Thank you.
thanks, Scott. See you.
See you.
Bye.